Buenas tardes, bienvenidos una vez más a Casting Strategies. Hoy tenemos con nosotros a una persona de esas legendarias de Wall Street. Es Jonathan Boyar y su firma de research, su firma de análisis, tiene nada más y nada menos que 45 años de trabajo continuado analizando compañías en Wall Street. La firma fue creada por su padre y ahora es llevada por John, con el que vamos a hablar sobre toda la historia de Boyar en Wall Street, sobre todas las anécdotas que han recogido a lo largo de toda esta historia en su compañía y también sobre sus planes de futuro y sobre todo con ese fondo que acaban de sacar con Mapfre para todo el mundo y en el cual van a aportar su research y su gestión. Hello John, thanks to be with us this afternoon. We are totally glad having you here in our show. Thank you very much. First, I want to say thank you for taking the time to be with us. The first question I'm gonna tell you is that Boyar Value Group, it has 45 years making research in Wall Street. It's an historical firm in Wall Street. How this firm start? Who started? And which is the story of the old days in Boyar Value Group?
Well, first, thank you for having me on the show. It's an honor to be here, and I'm glad to be able to talk with you. As for your first question, yeah, we're celebrating in January of this year. We celebrated our 45th year of being in business, which in Wall Street terms is centuries. I mean, that's a very, very long period of time. And clearly, I'm not the founder. I'd be very youthful looking if I was. The firm was started by my father, Mark, who's still very much involved in the business. And he started the firm obviously in 1975. And what he wanted to do was create a research boutique to sell stock market research to primarily institutions. And at the time, if you're a Wall Street historian, they were in the middle of a terrible bear market that made 2008 look easy. Yeah. So it was a very contrarian thing to, one, start a new business, and two, to start a business that was predicated on stocks. But he did it anyway, and it was the worst of times with the best of times, in the sense that he went right in the middle of a bear market, but he started to develop a great track record and a following, and made a very nice reputation on Wall Street. And we started to get some more institutional followers, and then people asked us to manage money. And that's kind of where we began. Our roots have always been in deep fundamental research, and we utilize that for our money management business.
Okay, so what I was saying is that I'd like to know a little bit more about your background and specifically about that period where you were working with Mario Gabelli. So I know that you were, before working in Boyar Value Group, you were working out of the firm, and you were learning, and in this case it would be interesting to know a little bit about your experience with Mario Gabelli and what did you learn from him?
All right, I mean, I learned a ton from him. He's a fantastic investor who built a great business, and he taught, one, looking how hard he worked, and two, how he analyzed businesses and how deep he went, and the expectations he had for the people who worked with him was something I tried to emulate. And as I said, working there, I learned a great deal. I also learned a great deal going to law school and becoming a litigator, which gives you an interesting background. But I've also learned a lot, with my father. I mean, growing up in this business, since a very, very young age, I've been exposed to the stock market, and it's I've learned the value of patience, of being a contrarian, trying to invest slowly over time, things that are more behavioral that you try and emulate and look at what other people have done and what makes them successful. And I think one of the things that sets us apart is that we do things slowly, deliberately, methodically, and don't just trade stocks for the sake of trading stocks. And I think that's something that separates us from a lot of Wall Street.
You are talking about making things slowly. You are talking about fundamental analysis. You are talking about research. What do you think about all of this? Is very close to value investing, philosophy. What do you think about value investing? Is that the part of your ideas when your father started the company to make something more in a value investing way, or it came later after learning how the market was going?
I mean, we were definitely always a value investor. I mean, in fact, my grandfather was a value investor who my dad learned from. So it's been ingrained in us from a very young age. But we have evolved over time. When the firm was started in the 70s, and some of it was a function of the time, there were more, quote unquote, deep value investing, maybe lower quality businesses that were just selling at really low prices. And that's a legitimate way of making money, but technology has made that somewhat obsolete. Everyone has access to the same screens. There's nothing unique or proprietary about it. So what we've done and evolved is try and find great businesses or very good businesses that are selling at what we think are significant discounts to our intrinsic value, that also have a catalyst, a reason for the stock to appreciate in a reasonable period of time. And to us, a reasonable period of time is 2 to 3 years, maybe longer. We like to hold stocks for much, much longer than that. But we're not looking for something that's going to make us money 6 months from now. That's, I think, a very difficult thing to do.
There's an interesting question now that comes up because of what you are saying. Your approach is a long-time, long-run period, but there's this research, this report, Forgotten 40, that your dad got started, and it's became a really, really interesting and acknowledged report by all the community, financial community, and it happens to see, if I'm not wrong, for 1 year, for the year to come. So it's yearly period, and actually it's beating the market all the time. So it's great, and it was your dad, if I'm not wrong, studied this report almost 40 years ago. So it's something really, really cool, and I'd like to understand that difference. Why you have this idea of this approach for long run investments, and at a time this Forgotten 40 report that is so acknowledged and so interesting.
Well, thank you for that. And there is a contradiction there, and I totally understand it. Forgotten 40 is one part of our research service, and we acknowledge that most investors are not as patient as we are. So we have to give them something that's going to have more instant gratification. Yeah. And we think it's helpful to look, what is going to, the purpose of the Forgotten 40, or what's in the Forgotten 40, is every year our team comes up with it, and we come up and look, what stocks do we think are going to outperform the major indices due to a catalyst we see on the horizon. But in order to get into that list, we had to have profiled it already. So they have to be what we think are good long-term investments, but also have kind of a shorter term catalyst as well. So we try to meld both of them together. But yes, there definitely is a contradiction there.
Oh, it's interesting.
It's very interesting because there are several managers here in Spain. Sorry, are you listening? Yes. Wow, crazy. There are some managers here in Spain that they are also doing the same as you. They are blending value investing approach with some catalyst that they see that they are impacting to the companies and making them to start running up in the market as you are doing in the Forgotten 40. And it sounds to me like several new managers that they are doing that here in Spain. And you are saying that Boyar Value Group is a research company, but it's also a manager money company. And I want to talk about the Mapfre deal that you have made to manage a fund. And I would like to know how many of these Forgotten 40 companies are you using when you manage the money, or how many deep value companies that you see for 2 or 3 years are you buying for this portfolio, and how you manage these two approaches?
Yeah, I mean, we're looking to take a long-term approach whenever we manage money. We're looking 2, 3, 4 years down the line. I think it's a lot easier to do that than to look a year ahead. So if you look at the fund that we're managing for Mapfre currently, there's a little over 40 names in it, and every single one of them have been profiled in our research service. That's something that's critically important to us. We do not generally buy companies for our clients unless we put out a thorough, deep research report on them. They go 10, 20 pages, and we try and find as much public information available about a company and determine what is a company worth, what would an acquirer pay for a given business. So every single name in that portfolio has a research report behind it, whether it was either in the Forgotten 40 or in our all-cap research service. It's a mix of both. But we don't really do deep value names anymore. We're looking for what we perceive to be high quality businesses that are just temporarily mispriced.
Well, that's interesting, John. Actually, there's a part of I've been checking your website and your the things that you place there, and there's a thing that it caught my eye, that is this kind of great consumer franchise type companies, and it was really interesting because, as I understood, you are saying that you are not looking for deep value companies anymore, but these kind of great companies. But I'd like to understand, I'd like you to elaborate a little this kind of term that is a great consumer franchise type investment.
Yeah, exactly. That's one of, we probably have 4 or 5 different methodologies that we use to find names. And one of our favorite is the great consumer franchises. We love looking for companies that resonate with consumers that people know. And to me, that's something very valuable. To us, it's something very valuable. It gives companies pricing power, and brands can be tarnished, but it's very difficult to ruin them. So if you find a company that has a great consumer franchise and they stub their toe, they make some mistakes, or Wall Street falls out of favor with them, like let's say 6 or 7 years ago with McDonald's, or a year and a half ago with Starbucks, that you're able to buy these great businesses significantly below what they sell for in the market. They generally sell for in the market because of problems that we think are fixable. That to us, that gives us a great entry point and a margin of safety. But something that's even better that we like to find are great consumer franchises that are masked by a corporate name. So if I told you Stokely Van Camp, does that name mean anything to you?
Not really, no.
Yeah. it doesn't mean anything to most people, but they make baked beans, not the most exciting business in the world. But in the 80s, we profiled Stokely Van Camp not because we liked the baked beans business, but because it owned Gatorade. The value of Gatorade was worth more than in our opinion, more the entire market value of Stokely Van Camp. So you have these great consumer franchises that are masked by a corporate name. So analysts might just look over them. They just forget them, or they just don't even realize that they own it. I mean, it sounds simple, but it actually works. Or a company like Binnie and Smith, which probably means nothing to most people, but they own Crayola crayons, which is another great consumer franchise. Especially if you have young children, you realize how important brands are. And these things still happen. A few years ago, a company called Acushnet came across our radar screen, and they owned Titleist golf balls and FootJoy golf gloves. So these things do happen. No screen in the world is going to come up with those type of situations.
It's like, as I see, something like these companies that are able to create value over time. Is that something like that?
Well, they're able to create their great companies, but because they have a name that doesn't really talk about or describe what the business actually does, they sometimes get overlooked. So as I said, it sounds very simple, but it leads to valuation discrepancies. Very real ones, and we try and take advantage of it. So that's why we think it's critically important to have a team of analysts do this research to come up with these ideas that most people wouldn't be able to come up with.
Yeah, thank you.
Going again to these deep value or quality situations, you are talking right now about totally quality companies, but maybe hidden in another names that no one knows, no? But you are talking about looking for totally quality companies, and you said that you are not anymore looking for deep value companies. What about the price? Because there is a big discussion right now here in Spain between the managers about the price that you are able to pay for a good consumer franchise, or for a good quality company, or for a technological company that is growing 25 a year. And some people say they don't want to pay the price that they see today in the market. Doesn't matter if the company is growing 25% a year, and they want to look for the deep value companies. But you are talking about quality, and maybe, I don't know, this is the question that I want to give to you. Maybe you are prepared to pay more price, or maybe not a good price, but a normal price for this company. How do you look to the price of the company that you are buying, these quality companies, and how do you think about the companies in the price, maybe the technological ones, and the price that they have today in the market?
That's a fantastic question. The most important part of the investment equation is the price that one pays for a business. You can have the greatest business in the world, but if you pay too high of a price for it, you're not going to make money. So you have to buy a company at a low enough price. One, it has to be, we think, a quality company, a good business, but equally important, it has to be selling at a price that we think won't be able to make money over time. The highest quality companies generally aren't going to sell for 2 or 3 times earnings. So you have to pay something, for it, but you don't need to. You have to be very price sensitive. You have to wait till they get into trouble where they have problems that you think are fixable. That might take a little bit of time. That Wall Street or investors aren't willing to, buy. Well, investors are very funny. They like to pay a lot for a business. Most people prefer, if you go to a store, you're trying to pay the lowest possible price, but investors, because the momentum, they like to, buy high. We think it's critically important to try and meld the two, find a quality business that's selling at a discount to what an acquirer would pay for the business.
Okay, John,
and as far as what you're talking about for technology companies, these names some of these companies are just selling at they may have great cash flow, they may have great businesses, great moats, competitive advantages, but if you're paid too high of a price for the company, you're not going to make any money. So we choose just not to invest in it.
Yep. Okay, so I have the last question from my side. That is, do you employ a different approach when evaluating small or even micro companies? Because we are talking about this high quality, this great consumer franchise, but if it is a small company or micro company, and I do believe that you invest because we're kind of agnostic to market cap investments. So how do you see this? Do you use different approach when evaluating these companies, tiny companies?
It's the same approach that we utilize for whether we're looking at the largest companies in the world or a micro cap. But because of the possibility of frauds or other items that are more associated with smaller cap companies, we like to see higher insider ownership or controlled companies where the founder or the CEO owns a lot of the stock, so his incentives are very much aligned with ours. Because when you get into micro-cap land, which we've made over the years, it has been a good source of value for us. You just have to be very careful. And one of the ways that you do that is if they own a lot of the stock, their incentives are very much aligned with you.
Mm-hmm. Thank you.
So, thank you, John. Thank you very much for being in our show today. Mutea, por favor.
Well, thank you for having me. It was a pleasure, and thank you for inviting me on.
And I know that we are gonna have your presence in our annual meeting here in November in Spain. That you are gonna come to talk with us and to talk a lot about investments, about new ideas, and you will share with us the new forgotten 40 ideas from the end of the year in this annual meeting. So we are very glad to having you there. Please look for something to tell us there in the meeting.
Absolutely. I always love to talk about stock ideas, so it'll be my pleasure.
Okay, thank you very much.
Thank you.
And I hope you have great success with your Mapfre fund, that you knew Mapfre found very, very good success.
Thank you very much. I'm really looking forward to working with them, and the one thing we can promise is we will invest it the same way we've always invested, utilizing the same approach.
So you will have a great success if you do that. Okay, see you again. Thank you very much. Y hasta aquí este casting strategies de hoy. No os olvidéis suscribiros al canal y darle like si os ha gustado.